Welcome to Making Money. This is Matt McCall. Thanks for joining me. Again, still out here at the annual Stansberry Alliance meeting in Las Vegas. Coming up right now, a gentleman who's been at our conference several times, one of the favorites here of our subscribers, and a favorite of mine as well. I read his work on a regular basis. He is the chief strategist and partner at Clock Tower Research. It's Marko, and we're going to talk about the big picture view. We're going to talk about some timely things that's going on right now in the Middle East. We're going to talk about the upcoming election next year, how it's going to affect the economy and your stocks. Great macro view. Very, very good conversation you cannot miss. Coming up right now on Making Money, Marko.
If you are focused on the AI market or chasing AI stocks, you must pay attention. Today, I'm urging you to look at another tech opportunity. And while it isn't AI, McKinsey says that this sector could grow by 30% every single year until 2030. I'm talking about battery metals. I first identified battery metals as a huge opportunity in 2009. And since then, lithium-ion battery prices have soared 900%. But now, with EV adoption accelerating, I'm urging folks to get in on a handful of battery opportunities. To help, I've released a brand new free report, the 2024 Battery Boom. In it, you'll find all you need to know about the coming battery metal surge. If you're a tech investor or a megatrend investor that's looking to cash in on a billion-dollar trend, you can't afford to miss this. Just visit 2024batteryboom.com to get a copy of your free report right now. That's 2024batteryboom.com for your free report.
Again, Matt McCall here at the annual Stansberry Vegas Conference 2023. He just came off stage. He's not been on the podcast yet, but he's been at Stansberry conferences several years in the back. Always a fan favorite. I get to see these things at the end, the feedback. Always one of the top 5 presenters that comes on. Marko from Clock Tower Group, chief strategist partner. Thanks so much for sitting down. I mean, I said when I introduced you on stage a little while ago that I read your stuff, and I do read it religiously. And it's what you guys put out there, big macro view, but you're giving us a view that you don't hear anywhere else. This is a view that you're really diving into it, but making it presentable that I can understand it too. You're not talking above me. So first of all, thanks for doing that, and we love getting your stuff. We're living in a crazy world right now. We could probably say that any day, but we are. So why don't we go with what's happening right now? What's going on in Israel about 2 weeks into the conflict over there between Hamas and Israel? What's the view that you're seeing from your where you sit?
Yeah, well, thank you so much for that praise. That's high praise, Matt, and that's why my team gets up in the morning to hear, that we are adding value. Israel Hamas war is obviously a human tragedy. I mean, first of all, Hamas committed a terrorist attack that is different than ever before, in that it was more like an Islamic State suicide attack, because it was a suicide attack. I mean, these guys hopped the fence basically into Israel and had no intention of doing anything but committing civilian deaths, and then not really surviving that attack. Yeah. And we haven't seen that from Hamas in the past, or Hezbollah. And so that's why it was a shocking event. However, in our view, it's not going to lead to a wider regional war. And I know that's a very controversial view. A lot of folks out there, Paul Tudor Jones just said that he's short equities because of this war. Yeah. Ray Dalio is talking about World War III. Yeah. I disagree with him. The region, none of the big players in the region, Saudi Arabia, Iran, or even Iranian proxies like Hezbollah, really want to take it there because the cost to them would be massive. The last time Iran did something to incite American retaliation was 1988. They mined the Straits, the Persian Gulf, and the U.S. conducted what was called Operation Praying Mantis. In 24 hours, the U.S. basically sunk the entire fleet of Iran. U.S. has absolutely no problem of, it has so many assets already in the region. It just puts 2 aircraft carriers there. It's almost daring Iran to retaliate. And if they do, if they take it to that next level, American retaliation will be vast, which is why Iran has just recently called for an oil embargo against Israel, which is vacuous. Wow. I mean, it's comical. Israel doesn't need to import oil from the Middle East. It can import them from somewhere else. It can import it from Canada, from the US. It's fine. So that just tells you that they're already kind of walking back some of their threats. Yeah.
So what about the Russian involvement? I mean, you hear different angles. Russia it kind of helps them a little bit, take maybe to focus on what's going on in Ukraine. Do you think that there could be some type of escalation with Russia getting involved?
Russia doesn't have the assets. First of all, I mean, Russia just lost the war in Ukraine. Let's just put it there. I mean, they couldn't even conquer the country next door.
So you would consider him a loser right now?
Well, we can discuss that.
Okay.
That can be like the next topic.
Okay.
I think it's more complicated than that. But I'm just saying, look, I mean, their goal was to conquer Kiev. They failed. And that's right next door. So their assets in the region are very, very minor. They have some ground assault fighter jets in Syria. That's it. They don't have power projection capability. It definitely benefits them. But what I would point out is everybody wants to talk conspiracy theories here. There's all sorts of talk that Russia orchestrated this, they helped Iran, that there's this new Belt and Road counter initiative between India, Saudi Arabia, and Israel, and that was the path of energy and infrastructure that Russia and China wanted to snip. Listen, guys, it's very simple. Occam's razor. I don't know how many of you know that concept. Occam's razor says when there's multiple hypotheses, the one that has the fewest variables is the correct one. So what do I think happened? I think Hamas just did this on its own. I mean, obviously, Iran supports Hamas, so in some way they're to blame. Russia obviously does the same, but if Iran was actually involved, if the intention was to incur maximum casualties on Israel and cause the worst damage, then Hezbollah would have been involved from day one, from time zero. You had that 4-hour window when Israeli forces, when Israel was unprepared, that was when Hezbollah should have been involved.
How are they not prepared? I mean, you always hear how amazing. IDF knows everything, and some of the greatest militaries.
Complacency. I mean, complacency. I mean, you have these fences, you have the wall against West Bank, and also there was just an assumption that Hamas wouldn't do something so suicidal.
Yeah.
I mean, this is the part that nobody really wants to say, but the reality is that this attack does nothing to security of Israel. I mean, it's shocking. Sure. People died. That's obviously terrible. But it's not like Hamas has any chance of conquering parts of Israel. Yeah. This is a terrorist attack. It is a terrorist attack, and Israel just wasn't prepared for such an illogical attack. So what is the logic then? Why did they do it? Again, I don't think Iran was involved. If it had been, Hezbollah would have attacked from the north on that right off the bat. I think Hamas did this to provoke Israel to invade Gaza.
Oh, wow.
I mean, why did Al-Qaeda attack the U.S. on 9/11? Same. They wanted the U.S. to retaliate. These terrorist groups want the victim to act out of revenge, to get sucked into the region, to go door to door in a high urban environment. That's what Hamas wants. And I suspect that Israel has had a cold shower, had time to think about it, and is saying, wait a minute, we are playing into their hands if we go door to door in a very complicated environment in Gaza. And that's why they're hesitating. That's why invasion hasn't happened. That's why we're hearing these weird rumors out of Israel that has been delayed because of rain.
Oh, wow.
In the Levant. I mean, I've lived in neighboring Jordan for 5 years of my life. I can tell you rain doesn't really stop anything ever. I think that Israel is recalculating what's the point.
Yeah.
This is what they want us to do.
So how do you think this affects the global economy, global stock markets? Is this something that investors should consider when they're investing?
So I think Ray Dalio and Paul Tudor Jones, I mean, obviously respect to them. Yeah. They're billionaires. Yeah. I'm not. They don't know what they're talking about. Yeah. This will have no impact on global assets. In fact, what is the global safe haven? What is the one asset you buy when something blows up? It's the U.S. Treasury. And the U.S. Treasury rallied for about a day, and then it's continued to sell off. I mean, right now we're recording this October, 18th?
18th, yep.
And the 10-year is at 4.9.
Yeah.
It's approaching 5%, which tells you that the main premier safe haven asset is selling off. Other things matter more. Now, oil prices have gone up. I think that's appropriate. Iran has increased its output by 700,000 barrels. And, the U.S. might punish them by saying hey, look, you can't sell this. That's worth 10, maybe 15% premium on oil prices. I'm also bullish on oil for other reasons, so that's easy to kind of see as the one implication. But this isn't something that's going to, that shouldn't cause you to make a decision, buy or sell decision on something like S&P 500.
Yeah, I agree 100%. When it comes to these geopolitical situations, especially this one, which I don't think is going to go to the world stage. I don't think it's going to be bigger. But somebody may know somebody from Israel, their family might be from there, so they start, overthinking, becoming emotional, and making bad investment decisions based off that instead of taking a step back. And you see that all the time.
Well, that happens all the time.
Yeah.
That's why initially when a geopolitical event happens, there's the dip over the next couple of days. But we put together this chart where we put every single geopolitical event of note. So we made a subjective call on that, what is of note, since 1945. And what it shows is basically the market dips and then basically goes back up. So these are always a reason to fade. I don't think that this one will have implications for markets.
Good. I'm happy to hear that.
Including Israeli, by the way, because Israeli market, not that viewers are really trading Israeli stocks, but they are the one asset that's dipped in this. And historically, when Israel goes to war, it's not bad for the domestic economy. So I would even fade that effect.
Yeah, there's the Israeli ETF. I think it's EIS might be the symbol. ISL, I think, is a closed-end fund as well. One of our colleagues, Dan Ferris, who you know, he is going to, now that we've taping this, he recommended that, I'm doing a panel, stocks that are going to kind of irritate you, like, wow, you're crazy for doing that. And that was his pick after this.
I think it's a great pick by Dan.
Yeah, I really like that. I do too. So other areas of the world right now, anything we should be watching, kind of China, Taiwan hasn't really been in the headlines as much anymore. Or even the political situation here in the U.S. We're about a year away from a pretty crazy election. I think it's coming up. Anything that investors should be looking at in the next 12, 18 months?
So I think that U.S. election is probably the most important event in the world from the sort of a non-economic perspective. And not because of the outcomes. I'm not sure that the outcomes, I don't know how to trade the outcomes. Trump versus Biden. Look, it looks pretty.
So I'm going to cut you off. It's funny you say Trump versus Biden. Like, you're basically, you believe it's Trump versus Biden no matter what?
I mean, act of God could prove me wrong. But I don't think that, there's time left to primary Biden in a competent way. And I think that, look, Trump's lead over his rivals is 30% higher than any other eventual winner of the GOP primary ever at this point in time. At this point in time, no candidate for the Republican nomination has ever had this big of a lead.
Wow.
I mean, it's astonishing.
I agree with you. I think it's going to be two of them, but it's, obviously I really put a lot of respect in what you say. For you said it pretty sternly, yeah.
I think it's highly unlikely that something happens to Trump that forces him to abandon the Republican nomination. And then I think that liberals and centrists might panic at some point in the summer with Biden candidacy and launch a third-party campaign, which would obviously scuttle chances of Biden's reelection.
Yeah. Do you think the Kennedy Jr. Is going to have any effect on this?
I think his support is too low to have an effect on it. I think a bigger effect would be, some billionaire decides to run and kind of captures like 5% of the centrist vote, which would hurt Biden.
Yes, exactly.
But look, I don't want to make a call on the election other than to say that people are dismissing Trump still. He is neck and neck in the polls. It's way too early. Lots of things can happen. But look at it this way. Unemployment is low. CPI has come down. The economy is fine. Why is Joe Biden so unpopular? So in other words, over the next 12 months, who here thinks the U.S. economy will be better? It's hard to make that call.
Yeah.
Like, I've been very bullish on the U.S. economy the last 12 months, did not expect a recession, but you cannot expect just everything to be Goldilocks for the next 12 months. So clearly things will become a headwind to Joe Biden.
Yeah.
And so why does this matter? It doesn't matter because of how to trade stocks in a Trump versus Biden environment. It's more like, what are the FOMC members going to do over the next 12 months? What is the Fed going to do if you have this anti-establishment candidate doing really well in the polls? And FOMC members are America's establishment. We've seen this in other countries, like France, when Jean-Marie Le Pen ran against Chirac in the early 2000s. The establishment of the country, both conservative and liberally, kind of coalesced like antibodies against the virus and, ensured the Chirac won whether people liked him or not. So I think that's something that could happen this time in the US as well. And the implication of that is that the Fed is likely to be behind the curve and not raise rates no matter how strong the economy is. No matter what happens to inflation, I think they had a window to cause a recession and for that not to have political implications. That window closed with the Silicon Valley Bank in March. They missed the summer of 2023 window. Now causing a recession will guarantee a Trump victory.
100%. Yeah, we're too close to the election at this point. Because we all have short memories. So if it happened 6 months ago, we could have forgotten about that.
With the
Something else would have
stimulus,
happened,
you
right?
cut rates, you do some stimulus,
Exactly.
things are fine.
Yeah,
But
we could have forgotten about it. Now you're right. But that, to me, tells me we should have a pretty damn good economy heading into the election, because I think the FOMC is going to make sure interest rates don't affect that in any way.
I think that could be the outcome.
Oh.
Or at the very least, the bond sell-off, which is a problem for stocks. It's a problem for the economy too, as the 10-year rises and eventually becomes an impairment to borrowing costs of corporates. How does the Fed react to that? So does the Fed just let that happen? And the question really is, where do bond yields stabilize? Do they stabilize? If they continue to sell off, I could even see the Fed intervene directly in some way. I mean, very strange things could happen over the next 12 months. I don't know what they're going to be, but my bias is to expect the Fed to lean towards leniency rather than be obsessed about the 2% inflation target.
And what about the fact that since the last meeting, where they paused it at that point, yields have gone up about 50 basis points. So are they almost pricing in another quarter point on November 1st meeting or maybe a mid-December meeting? Because it's the market, I feel like, it's priced it in already.
Yeah, so I think that it's not related to the higher for longer. I don't think that's what's leading the sell-off in the back end. I think what's leading the sell-off in the back end is that a lot of investors, especially large pools of capital, are repricing neutral rates and growth. In other words, they're repricing no recession. Mm-hmm. So we were stuck at about 375 after Silicon Valley Bank collapse. There was this, debate about a recession, and then in July, August, and September, we got really strong data. Then we had the FOMC meeting. And I think what a lot of investors are realizing, like, wait a minute, I've been holding these bonds in anticipation of a recession that's not coming. Mm-hmm. So hear me out. This is the part of the paradox and where it's illogical in a way. The back end of the curve is selling off because of optimism, because the economy is strong, because the US consumer can basically look through 5.5% Fed funds rate. And then the Fed looks at that move and says, ooh, that's too much, we're going to be paused. So the Fed is pausing because the economy is strong? Mm-hmm. Like, how is that bad for risk assets? Yeah. You see what I mean?
Yeah,
like they're backing off. Yeah. They're pausing because, ooh, bonds have sold off a lot. The 10-year yield has gone up. And it's like, yeah, but it's gone up because the economy is strong. So you should be raising rates now. You should actually be trying to catch up to the long end, not the other way around. And they're saying that they're going to pause. So I think that's what's...
I'll tell you what, Marko, that's a great way to look at it, because like you said, if you're in a strong economy like that, you raise rates to cool it down.
Yeah.
Yeah.
So what is nominal GDP growth next year? Let's say 1% growth, real, and then 3% inflation, maybe 4.5% nominal GDP growth. If I said to you, ceteris paribus, all things being equal, US nominal GDP growth is 4.5. What is the Fed doing in that environment? You're probably saying they're raising rates. And that's why I think what's interesting to me is that this bond sell-off is because of the strong economy, optimism, and yet the Fed is saying, oh, we're gonna pause because of it. I think that's actually revealing this political bias, which a lot of Fed watchers don't want to admit because they're not experts in politics. So they are reading FOMC, transcripts as if they're like holy scrolls, and there's this whole cottage industry in our industry of reading FOMC statements and trying to interpret what these demigods, think. And I just don't think any of that really matters. I think it's very simple. Election's 12 months away. It's a pretty contentious election. Lots of establishment, members of the American establishment, including conservatives. I mean, not just liberals, don't want Trump to get reelected. They're not going to try to get a recession.
Yeah. So you've been saying for a while now that we're not going in recession. Is that still your viewpoint?
I think yes, but obviously conviction is lower because now it's consensus. Mm-hmm. And as I said in one of our panels, I said when everybody thinks there's no recession, that's when the recession happens.
Exactly.
And why? What is the mechanism by which that happens? It is the long end selling off. Because if there's no recession, you don't want to hold long-dated bonds. You don't need to. You want to be in risk assets. The 10-year goes up. Borrowing costs go up. They matter more than the Fed funds rate. And that impairs the economy. So yes, I don't think a recession is coming, but I'm also bearish bonds. So I think there's a balance where the 10-year yield, if it goes 5.5%, 6%, you got to change the view under no recession call.
Sure. Well, it's interesting here you're bearish on bonds. I'm on the opposite right now. with my own personal money, I've been picking up, and I'm not a bond player. That's not normally what I do. I guess it's more of a long-term play. I see it as some opportunity, but I'm second-guessing it after the last couple of weeks. Obviously, I'm down on that position, but I am second-guessing a little bit, hearing from you and other people reading things that maybe I'm wrong here.
Well, I mean, look, there is always that whole thing, I'm going to keep it to maturity and pick up 5%.
Yeah.
And, if that's what you intend to do, I think that's perfectly fine. Mm-hmm. As long as you understand that the principal may be worth, 60 cents on the dollar.
Yeah.
And if you're cool with that and you're going to pick up 5% coupon, then it's not a bad call. Mm-hmm. It depends on what you're doing with those bonds. But I'll tell you this, a lot of the large pools of capital, pension funds, sovereign wealth funds that I speak to, they didn't buy these bonds just for the coupon. And they bought them when the coupon was much lower. Mm-hmm. And they bought them thinking about the principal as well. And so for them, if the fair value yield that they thought was 3% is now 5%, what do you do with that? Are they going to start dumping it?
Yeah.
And that's where the value of the bond, not the coupon, is potentially going to go down further.
Yeah, there's been a lot of great debates the last couple of days about bonds, and it's one of those times that we don't have a consensus. I'll say the consensus this year, 2 years, let's go back to 2021 when I was here. Almost everybody was bullish, right? And what a great time to get out of stocks. This year, I'd say 80 to 90% of the speakers that we brought on are bearish.
Oh, wow. On bonds?
No, on the market. Sorry, on the market. Yeah, right. Bearish on the market, and they're bullish on equities in 2021, which of course they peaked, around that time frame. So I'm not saying that all of our speakers are wrong, but I'm a contrarian, and when everybody's on one side like they are now, I tend to be bullish on equities at this point, and not just because of that, other reasons as well. But I just see it, and when everybody's on one side, I'd rather be the wolf than the sheep.
Well, what I would say is look, if we are nearing a recession, if the consensus is end of 2024, I'm probably okay, I think 2025. I'm not I'm not saying no recession ever. Yeah. But what I'm saying is it's important because if yields are going up and oil is going up, stocks probably go up too. For a while, it's that last decile of a cycle, which tends to be the second most lucrative. Okay. So don't forget about this. Now, if you're a retiree, you shouldn't be chasing pennies. You shouldn't be picking pennies in front of a steamroll. Can you miss that last decile of a bull market? Yeah. Mm-hmm. You probably should because whatever, it's okay. If you're a professional investor though, you lose your job. Yeah. The two deciles, the two kind of most important innings of a cycle is the first, the Fed cuts rates, equities bottom, you have a huge rally, and the last. Yeah. So missing that last one is actually problematic, and we could be in that last inning right now. Now, the problem though is if 10-year yield goes up, I will say this, the best performing stocks in the US shouldn't do well. Mm-hmm. So that's where this rotation out of tech could be problematic for S&P 500. Mm-hmm. But for value investors, this might be a good opportunity to pick up something or, looking at non-US stocks, especially if I'm right about the Fed. If I'm right about the Fed and they're behind the curve, the dollar could fall as well. Now, low conviction view, let's see what happens. But if that happens, this last decile, which could last 6 to 12 months, could be really good for emerging markets, commodities, and global stocks.
The tough part about that last decile is you need to know when to get out then too, because that last decile, like you said, it's the big move, but when you're in there, it's FOMO. Well, it's going bigger, and it 100%. Usually comes down pretty fast.
It comes
right?
out, yeah. What is that saying? Stocks take an escalator up and an elevator down.
I like that. Yeah. Exactly. Well, hey, listen, I know you got a busy rest of your day, but thanks so much. I know. All of us that work here, all the attendees, love seeing you, love reading your stuff.
I love coming here. This is a great community, and I just love seeing so many people who are just so happy to be here. That just means Stansberry is doing a great job and adding a lot of value to a lot of people, and I love coming here.
Oh, thanks again. Well, of course, we'll see you again next year here in Vegas. So again, coming to you live at our 2023 Alliance Conference here at Stansberry. That was Marko Popic, and I'm Matt McCall. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.